For Morningstar, I'm Jeremy Glazer. Small values had a big turnaround so far in 2016. I'm here with Russ Kinnel. He's our Director of Manager Research to look at some of his favorite small value funds. Russ, thanks for joining me.
Good to be here.
So let's talk a little bit about this turnaround in kind of performance for small value. It went from kind of the bottom of the pile to the top, while on the other hand, large growth went from the top to the bottom. Is this just kind of normal cyclical behavior, or is there something more profound going on?
I think it's normal cyclical behavior. You always have the markets and the economy have rotation naturally. So last year, energy, natural resources, some of the stuff you see a lot of in small value were getting crushed. Now they've been rallying. Conversely, healthcare and tech names had a tremendous run for a number of years ending last year. So large growth was great last year. This year they've come down to reality. And of course, there's also a pricing element too. As those areas do really well or really poorly, we tend to overreact. And so growth and tech and healthcare did really well, and that meant they were kind of pricey and therefore vulnerable to a little bad news. On the other hand, you had these natural resource areas that so many bad things were already priced in, just a little bit of good news would help. And so it's sort of a natural cycle to see, and it's just particularly pronounced this year.
So this is an argument to stay pretty broadly diversified?
Yeah, I think stay broadly diversified. Don't give up on a sector. If you've got all of your investments and say it's year end and you're just saying, okay, I'm going to sell the thing that did worse and put it into the thing that did best, you may be inadvertently buying high and selling low.
But after this run-up in small value so far in 2016, is it still time to maybe look at a small value fund? Is there still some managers there who you think could be worth taking a closer look at?
Sure. I think you definitely have already missed some of that run. But if you're really looking out long term and you're planning for 10 or 20 years, it's probably always a good time, because I don't think you want to worry too much. I wouldn't jump in with the idea that the next 12 months it's going to keep outperforming. I have no idea if that's going to happen. But I think you always want to build to that long-term plan. And if you've neglected small value to this point, I think this year is a good illustration of why small value, for some of its quirks, has some good diversification value for a portfolio.
Well, let's look at some of those strategies that you like. What's the first one?
Right. Well, I actually chose to highlight some funds that are doing particularly well this year. But we also have medalist ratings on them, so they're good bets long term. Royce Special Equity is one that's up over 12% this year. It's a fund run by Charlie Dreyfus, who's kind of an accounting geek who just really likes clean balance sheets and sort of typical stuff is driving just boring retailers and industrial names, and you really just it's never very exciting names in the portfolio, but that's kind of the beauty of it, is that you have good balance sheets and low valuations, and you get years like this at a fund like that.
What's the second one?
Vanguard Small Cap Value is doing really well this year. It's silver rated and it's up 11% this year. Interestingly, the small value category does not quite match its sector weightings. The index funds financials weighting is significantly less than the peer group, and so that's been helping its performance this year. But of course, that's not why you buy it for long term. You buy it because it's very cheap, and those low costs work year in and year out, and so that's why you would own it for the long term, even though there's some quirks that are helping it this year.
And what's the final fund that's done well?
Perkins Small Cap Value. It's a little like Royce in that it really likes cheap, boring names. They've got packaging, the name that's doing well, a filter maker, a pump maker, incredibly boring stuff, but it tends to be cheap, tends to be cyclical, and so this is a sort of fund that will have a 2 or 3 year run that they really do well, then they may give a little back, but it's still a really well-run fund, and we rate it silver.
Well, Russ, as always, I appreciate your insight. Thanks for joining us.
You're welcome.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.